So this brings me to our first panel and its moderator, Jonathan Chevreau. John became editor of Money Sense magazine in 2012 after a 19-year career at the Financial Post, most of it as its personal finance columnist. He has written several books, including The Smart Funds Mutual Fund Guides and The Wealthy Boomer. Most recently, he wrote the financial novel Findependence Day, and earlier in his career, John was a technology reporter for the Globe and Mail and was editor of several trade and consumer publications. He is currently active on the major social media platforms, and you can follow him at John Chevreau on Twitter, and writes the Financial Independence blog at moneysense.ca. John also writes for the Investor Education Fund's Money online blogs. Please join me in welcoming Jonathan Chevreau to the stage. Jonathan.
Today's first panel is the Fees and Advisor Compensation panel. And as you know, regulators, both domestic and foreign, are increasingly turning their attention to the advisor-client relationship, including a focus on how advisors are paid for their services. Some jurisdictions, such as the United Kingdom and Australia, have moved already to ban most forms of embedded compensation, which is by far the preferred payment option for many of the advisors who serve Canadian retail investors. The CSA's recently launched review of mutual fund fees has many of us wondering if embedded third-party commissions may be on their way out in Canada as well. Of course, any legislated ban on fund commissions could have dramatic implications for the future of the various advisor payment options currently available to the Canadian consumer. So we're going to look in this panel at these payment models and the possible consequences of banning fees and commissions. So we'll open the panel with Ed Squark, the Vice President of Regulatory and Public Affairs at Advocis. Prior to joining Advocis, Ed was legal counsel with the Ontario and later the British Columbia Securities Commissions, and he's worked for several of Canada's largest financial product manufacturers and distributors. Ed holds an LLM from the London School of Economics, where he studied the structural development and policy implications of complex financial instruments in the banking, securities, and insurance sectors. Next on the panel is Ken Kavenko, who is the chair of the Advisory Committee of the Small Investor Protection Association, or SIPA. Ken's a member of several corporate boards and a director of Excellence Canada. Also, he's a member of the Ontario Security Commission's Investor Advisory Panel and a senior fellow of the American Society for Quality. Ken currently runs CanadianFundWatch.com, which helps small investors with mutual fund investing, and he's the president of Kenmar Associates, which is dedicated to investor education and helping investors obtain restitution in cases of advisor or broker wrongdoing. So welcome, Ken. After Ken, we have Jonathan Bishop, a research analyst at the Public Interest Advocacy Center, which I call PIAC. Of late, Jonathan's focus has been on the Canadian telecommunications and financial services sectors. This is Jonathan. Prior to PIAC, do we call it that? Prior to PIAC, Jonathan was a parliamentary affairs and stakeholder relations officer at the Competition Bureau, and he also spent 8 years working in the Senate and the House of Commons as a policy advisor and legislative assistant. And the final voice on the panel belongs to Robert McCullough, who started his career in the financial service industry more than 25 years ago. In 1999, Robert became an independent broker with Benefit Planners, Inc., and he has since built a successful practice comprised of individual clients and their families, as well as small business owners and entrepreneurs. Since 1997, Robert has taught in the CFP program at Mount Royal University and the University of Calgary. Robert is a past chair of Advocis, an active member of the Advocis Board of Directors, and a member of the $1 Million Roundtable. So welcome all panels, welcome to everybody, and I guess we're going to start. We'll start with Ed.
Okay, just to get things started, I thought I'd give a bit of a recap on where we are in terms of the banning of third-party commissions, starting with looking at what's happened in Europe. It was in 2007 that the UK Financial Services Authority issued a consultation document looking at the retail distribution of products. And this had a lot to do with issues they had about mis-selling. And certainly the outcome of that review demonstrated serious flaws within the regulatory structure there that allowed for serious mis-selling to take place, costing consumers billions of dollars. So they had to take action. So the Retail Distribution Review was looking at the unit trusts or mutual funds, saying, how can we take steps to ensure that clients are more appropriately protected? As they moved along in that study, they recognized that due to product convergence, they wouldn't be allowed to simply look at unit trusts. They'd have to start considering insurance products as well that had investment components. So what we saw was the development of the consultation document, and early on they identified the conflict of interest through embedded commissions, and said the cure then for all the ills that are facing the UK would be the banning of third-party commissions. And that took effect in January of 2013. Australia also followed suit. They had issues there, Opus Prime and Storm Financial. Again, consumers lost billions of dollars, and there was a lot of political pressure to say we have to do something to clean up the industry. They again decided that they would follow the UK suit and ban third-party commissions, and also established statutory-based fiduciary duty, which is very much similar to what exists in Canada under our common law statutes. So Canada, several years later, our regulator said, well, maybe we should be looking at what's happening as well. And in December of 2012, issued a consultation document looking at the fees issues. Without coming out and saying they're going to be banning commissions, the document certainly leads to that sort of discussion. And the issue that Advocis has raised, and a number of different groups as well, is that we don't have the same sorts of problems that the UK has had. Why are we using cures for ills in other jurisdictions to address problems that don't seem to exist in Canada? We are working on greater transparency on fees through National Instrument 31103, and that transparency project is working through the system and won't be fully implemented until 2016. And often it's viewed as transparency can cure conflicts that appear to exist. Also in Canada, we don't have a situation or an environment where insurance and securities are regulated together as it is in the UK and Australia. So we're seeing the securities regulators moving towards discussions about issues absent the insurance industry following suit. And that's really setting up the grounds for regulatory arbitrage, where if you're doing certain things on the insurance side, not on the security side, it just doesn't seem that it's going to fit or work properly. And in just closing in my opening remarks, what I would like to note is that, and it picks up on issues that I think are going to be discussed a lot today, the advice gap. It's only been a few months in the UK since the banning of third-party commissions has taken root, and already the FCA, the Conduct Authority now, Financial Conduct Authority as it's now named in the UK, has recognized that there is a problem, that there were unintended consequences with what they have done, that there is an advice gap, that people making less than, or have, with less than 50,000 pounds of investable assets are not able to access advice anymore. Those with 50,000 to 100,000 pounds are getting far less advice than they were in the past. So these are the sorts of issues that we think have to be discussed, because there's no greater need today than ensuring that people are investing for their own financial futures.
Thank you, Ed. Certainly the numbers that were presented earlier suggest that, what was it, almost half of Canadians don't have a lot saved, and this is a scary prospect, them having no advice at all. Ken Kavenko, I'm sure you have a somewhat different perspective.
Well, I agree with some of the points Ed has made. I'm a system engineer. I'm a consulting engineer. As a consultant, I consider myself as an advisor. So I am an advisor, so to speak. And I have advisors. I have a tax accountant advisor, a lawyer that advises me on legal issues. So I believe in professional advice. I understand as a system engineer that I have to look at a problem holistically. So I don't look at just the investor issues. I'll just briefly explain some of them. We don't like the fee structure altogether, but it's not just the structure. We don't like the fees. The fee levels, if you make 5 to 7% on a portfolio going forward, which is what most economists economists say. You take off 2.3% for the MER and 0.1 to 0.5% for trading expenses, inflation, and taxes, you basically end up with nothing. So we're saying something has to change. It's not surprising, some of the statistics that were given about retirement. How can you retire if you save and you earn nothing? So there has to be a change. And it's impossible to have improvement without change. You cannot improve anything. It's a law of physics, and as an engineer, we know you can't go forward if you don't change anything. That's the definition of a lunatic, is when he doesn't want to change anything, and yet he wants something to change. So something's going to have to change. What are the driving forces? There are many. Investor advocates are pushing. The media is definitely hostile to the industry. At the same time, all the banks last week, and you talk about your industry being troubled, reported the highest earnings. Their stock prices, all banks hit an absolute all-time high. So somebody is making money. Whether that's flowing down to advisors who work for them, I don't know. But a lot of money is being made. And the stocks have gone through the roof, and they will continue to, even though the rest of the economy isn't doing well. The regulatory arbitrage, I agree with you. We're bumping into it at OPSI as well, where the segregated funds, so we agree with that. Is everything working properly? Are there enough professionals? We don't agree with that. We think that in the case of mutual funds, the proficiency requirements are far too low to give the kind of advice that they claim they will give. I deal with complaints, and I have so many, like I have 50 people now helping me, volunteers, retirees, with complaints. We are so overloaded we can't cope. Bad tax advice, absolutely flawed advice. Estate planning that a lawyer should have done it. This should not have been done. So what is the definition of advice? And the proficiency of advice is very important. Other driving forces, and I'll finish in a minute, are ETFs is another threat to the industry. BMO Advice Line, which is a online system where you need only 100,000. I say only, I mean, it captures a lot of people though. Basically, you'll be able to do it online with some human intervention. I see these models building up in Australia now, and in the UK and the Netherlands and Japan and Israel. They're very powerful. I don't know if you tried you can try some of them out. They're unbelievable. Some of them will actually make a financial plan. Now, it takes 3 pages of data you've got to feed in, but it will do a wonderful job, and there's human intervention. The regulators gave an exemption to BMO, and I think they're going to approve it now as a standard. It's working quite well. I believe I have quite a lot of assets. So I could go on, but there's a lot of issues with the structure, and it's more than conflict of interest. It's the level of the fees, and all the fees, and the DSC is also hurting seniors. And my last point is advice gap. I am terrified now that I am a senior. I finally accepted I'm a senior. I don't see enough advisors that know how to handle accounts that are deaccumulation. They're very good, or they're reasonably good on growth accounts, but when an account keeps declining year after year and the money is used for living expenses, and they have to understand withdrawal rates and a lot of mathematics and statistics, I don't find there's enough advisors that know how to handle the seniors and RIF accounts.
Thank you. Ken, I'd agree that the level of fees in Canada is probably a bigger concern, at least to our readers, than conflicts of interest. But let's take the perspective of Jonathan Bishop at the Public Interest Advocacy Center.
Thanks, Jonathan. It's a pleasure to be here. PIAC is, for many of you that don't know, provides legal and research services for consumer organizations. We specialize in the areas of telecom, energy, and financial services. We delve into issues regarding competition law, privacy, and e-commerce for the most part, and general consumer issues. We studied the financial planning industry in both 2008 and 2012. We based this research primarily on focus groups, and then used, to be blunt, a lot of your own industry research to feed into and accommodate our own research. During those two occasions, we found that clients and planners themselves were a bit confused over the use of titles and designations and things of that nature. I'm not going to get into that right now because that's not the focus of the panel. However, what I am going to say is that during those two sets of focus groups over the 4-year spread, that few of those involved in the focus groups mentioned that they were told about these fees, or that advisors, they thought it was an obligation on the part of advisors to disclose these fees existed, or that how they were being remunerated. Many claim to not get this full disclosure, as I say, on the not on the up note, but surprisingly few were not particularly concerned as long as their portfolio was continuing to grow. I know that in the discussions we've had, that we're going to talk about probably CRM1, and we're probably going to talk about, isn't that going to take care of some of the questions that we're going to address today? I would suggest that the MDFA recently came out with some research saying that some of these obligations that were supposed to be met under CRM1 aren't necessarily being met at this time. There are some gaps there. And that for PIAC, what we decided after going through this review is that not necessarily a ban was required, but a middle-of-the-road discussion where we evolved to having basically a two-tiered system where commissions were allowed until a consumer had a portfolio of a certain size. Then it was decision time. The consumer had to be made aware of a different model, and then a consumer can make the choice to go into a fee-based service rather than having to continue to deal with commissions. We also recommended that a tax credit be applied to make consumers more aware that there are more than one model of compensation out there. And I look forward to engaging this discussion for the next hour or so. Thank you.
Thank you, Jonathan. Robert?
Well, good morning. It seems appropriate that I disclose that I'm the advisor at this front. I'd be the person who's about to inherit this occasion, and I'm reminded of the story of the chicken and the pig in the farmyard who decide the farmer's been pretty good to them and maybe they should do something for him. And so the chicken looks over and says, "Why don't we make the farmer breakfast?" The pig thinks for a minute and says, "Wait a second, I'm committed and you're participating." So gentlemen, this conversation in my mind reminds me of the power of trust, which is the residue of promises kept, and the importance of our client relationship based on trust. The necessity for us to provide advice and close the gap by building that relationship and continuing to deliver the services. And Mr. Komenko, I appreciate your point of view, but I'm stunned to think that by eliminating commissions, you expect more people to move into a space that you highlight as being so desperate. Desperate in the deaccumulation process, desperate in the necessity to give good advice and close the gap and provide seniors with that opportunity. However, I'll go to my prepared notes because it might keep me more directed. I appreciate the opportunity of speaking on this issue, an issue that I'm reminded of when I go to my dentist and I get advice and I don't really get a second opinion. I have to trust that the relationship I have with my dentist is a professional one, that they're going to tell me what I need at the moment I need it. The same relationship that I share with my mechanic when he tells me I need to replace something in my car to keep the maintenance and care of my car in good order. Today, we're sitting looking at fees in the past, which when my first mutual fund sale, I brought a stock advisor in because I thought I wasn't sophisticated enough and watched him sell mutual funds with a 7% front-end load, which today, according to Invesco, 90% of front-end fees are 0%. And I'm thinking about the fact that I see an increasingly declining DSC platform for the majority of people. But you're right, the CRM1 and CRM2 is beginning to bring into focus the necessity and the ability to disclose fees, to clarify fees. And that will lead to a stronger position of trust for an advisor to have your clients understand how the fees are being charged and indeed what they're paying. Increasingly, the media is bringing that forward. I recently had a client phone me and say, I spent the entire weekend thinking about you. When my assistant heard that, she said, he needs more to do on his weekends. But he said, I'd read all the financial papers over the weekend, and they all tell me I'm paying too much in fees. I said, well, let's address this. Come in, we'll sit down, and we'll go through the fee structure. And I explained to them that the MER is a representation of 4 separate sets of fees, that there's a portion of that which goes to money management, which is where the advisor, or the company, employs people to do research to find the appropriate portfolio to keep his portfolio in check with what we originally set out. That there's a portion of that that goes towards the administration, the receipt of the T5s, T3s, the statements, and the ability for him to go online. There's a portion of that that was paid to me, but I don't get the entire portion of that. I have to share that with the supervisory group that oversees what I do to make sure that I'm compliant and fair. And then the latter part of that was for an insurance wrapper. And we went through that fee structure, and at the end he said, thank you. I now understand them quite clearly, and I appreciate the value you bring. So as we look forward, if we just do a thought experiment for a moment and think about the world with a commission ban, we would maybe explore this a little bit. The OSC is looking at banning all commissions on mutual funds, and advisors and clients will find themselves in a position where they have to move to some sort of a fee-based. There's still going to be a need to be feed. It doesn't matter whether we do it and embed it or whether we do it by negotiation. That's a contemplation around looking at a fee. But if we continue on with this, we then have to explore whether we're going to look at an asset-based fee or whether we'd look at a fee by the hour. We'd have to contemplate whether we'd look at hourly or whether we'd look billed as communicated. And from all communication and all that I can see, it looks like 1% is somewhat the target. And I'm concerned when I hear panelists say that, you know, fees seem to be high and this process doesn't seem to work, so let's just eliminate them. And perhaps what we should be thinking about is maybe a cap. Perhaps what we might be thinking about is a negotiated position that looks at 1% being the current today and the expected in the future. The question will be, what will be the effect on the small and medium? We heard Greg Pollock this morning speak about the fact that the average consumer has $228,000 in assets to look after. That question will be, if that's the average, then the contemplation is there's a significant number of people less than 228,000. And how will their service model change when the advisor's compensation is reduced to a point where the economics of business will step in? So as we continue this, we have to ask the question, what's the outcome? Why are we doing this? Why do we want to end up with it? It seems at a time when we have the necessity of more information, not less, more advice, not less. When we have a gap between literacy and necessity, it seems strange that we're trying to eliminate it to those people who need it most. Further from the presentation this morning, we have 37% of people who have under $15,000, I believe it was, and 57% who have under $25,000 of money to invest. We have to ask the question, at that rate, what kind of advice can they seek? And I strongly speak against the connection between profits of a corporation and compensation to an advisor. I don't see any connection between those two at all. So as we look around the world and we look to see bans, we see problems that crop up as a result of unexpected consequences. And I think the purpose of today is really to explore the consequences and explore them with some outcome. The access to advice is really the point that we need to focus on. How are we providing advice? How do we increase advice? How do we have people take advice and benefit from it? Currently, there's 10 million Canadians receiving advice from financial advisors. There's a significant number of people who are collecting and receiving and benefiting from that advice. We're needing advice more than ever. And it should be noted that there's two basic facts. As an advisor, I and my colleagues adhere to a know your client and know your practice suitability requirement. And second of all, that mutual fund sales are not driven by compensation, but the client's own needs and goals. And from that perspective of responsible policy formulation, there's simply no getting around that the facts represent professional realities of what advisors do. I'd like to conclude with 3 thoughts. 1, embedded commissions such as mutual fund trailers provide retail investors with affordable access to financial advice in a current market. 2, Canadians attain better results working with a professional advisor, as evidenced in the Serrano report from 2012, which illustrates that the longer you have a relationship with the financial advisor, the better off you are from a wealth perspective. That over 15 years of relationship will lead you to over three times the amount of wealth of not having a relationship at all. And third, the unbundling of fees will lead to the cost of advice increasing, with many Canadians simply deciding to forego financial advice and striking out on their own.
Yeah, well, that's interesting what you just said, because the perspective of Money Sense magazine is, I guess you could say, a lot of, at least our reputation has been that we have a fair number of emerging affluent clients who are indeed striking out on their own. We're quite famous for the couch potato portfolio, and a lot of them will go to discount brokerages and buy their own ETFs. Now, as the editor, I think that they should also have financial advice. What I find that this 1% that you mentioned, ultimately you stand to lose that. So what I find, and I had a discussion just before at the table with someone who said he was switched from he was quite happy in a commission model, as I was early in my career, investing career. And when we were switched to the asset-based model, percentage of assets, that's okay at a certain level of assets, but as long as it ratchets it down at a certain level. A reader last week contacted me saying he had $4 million, and they insisted on 1%. I said, that's $40,000 a year. A lot of people can live on that. Why wouldn't you be negotiating that down to, I don't know, 75 beeps, 50, or whatever? And I think this is the point where a lot of people, a lot of clients, your clients, if you don't start to ratchet down that asset-based fee at $1 million, et cetera, then you indeed stand to lose them, that they'll go to a discount brokerage and any fee, a time-based. And this is the other big confusion. Preet Banerjee down there wrote an excellent article in the current issue of Money Sense, the November one that's on the stands, where he talks about, one part of it was what the heck is a fee-only financial planner? And what we found is there's this huge confusion in terminology between fee-for-service and fee-only. As far as I can see, fee-only means, all it means is no commissions. Our readers, we had for several years had an online directory of fee-only planners. I believe that the readers thought that this was directing them to time-based or project-based advisors so that they could buy their own ETFs at discount brokerages. They valued advice, but they didn't want to pay, as in the case of the $4 million man, $40,000 a year. What happened, though, the term fee-only also, in that directory were a lot of asset-based people. And quite rightly, the definition in the United States is that basically fee-only can refer to either asset-based or fee-for-service or time-based. So what we've done is, and Preet's article, I urge you to read it. You can read it free at moneysense.ca. We broke the directory into these two pieces so that now that the people, the ones that I warned you, I think are starting to move away if you don't take the fees down a little bit. They can find, we actually call them money coaches, who are not even qualified to sell financial products, but they focus on debt management and that kind of thing. If they want to have asset-based or mostly asset-based, but with the option of fee-for-service or time-based billing or by project, they have that option. Anyway, I'm sure, Ken, you might have some comments on what I just said.
Well, that's what I was talking about, fees. If you look at the fees of a mutual fund, it's not just the embedded commissions that's the conflict. The SPIVA report came out and said that 85% of mutual funds after 5 years failed to meet a passive benchmark managed by nobody. So 8.5 out of 10 funds can't even meet a benchmark that nobody is running. So the fees are part of the problem. You might as well buy an index fund or an ETF. Now, how many index funds are being recommended even though they're superior to these mutual funds? 1.5%. That's all. So what is wrong? Why wouldn't an advisor recommend an outperforming fund, still be able to collect fees under a certain model? He could probably charge more, and he would make more, or she, and the investor would make more. What's wrong with that? And there's no breakpoints. If you look at the breakpoints of mutual funds, they're either not disclosed or they're so high that they're meaningless. So really what's happening is the wealthier, the 4 million or 1 million people, are subsidizing the smaller investor. And when I went into mutual funds, I never intended to be a charity. So these people are going to have, the mutual fund industry is going to have to stop acting like Kodak or RIM, and realize that the winds of change are blowing, and if they don't change, they're going to be sorry.
Robert, you wanted to say something?
I have a couple of comments. Number one, I'd like to point out that in 25 years, the winds of change have blown since the day I came in, and while they're continuing to blow, the distribution model that we work in is significantly different. And whether the more wealthy clients subsidize the less wealthy clients, we're talking about the necessity of closing the gap in financial literacy to necessity, and how we solve that problem, which is quite different from allowing a consumer, and Jonathan, this was the point that I wanted to bring forward in hearing your comment. You speak about the $4 million man paying $40,000 a year, and I think about an open free market where that individual can seek other alternatives, and that those other alternatives exist. And we're talking about altering the marketplace so that those alternatives no longer exist. And I wonder to myself as an advisor why we don't allow consumers to be the ultimate chooser or choice as to how the market should operate. I don't understand why we would take away opportunity for consumers to participate in a model that they feel most comfortable with. And that, in my experience, when I've sat down with clients and said, there's a wind of change coming, and that change may spell my necessity to hand you a bill, they look puzzled at me and say, I don't understand. That's not something I'd like to participate in. I'm quite happy with the way it works. And I say, well, you may be happy, but the people who govern us aren't. And they look puzzled that they don't seem to see a connect between what they have as a concern and the fact that somebody's taking away that choice from them. And that how great it is that your client or your reader can now go back to the marketplace and go to a discount broker, that there are other alternatives.
Or even full service. And I've written this, I think full service commissions in Canada is actually a great deal, particularly if you're a buy and hold investor. I mean, if you just buy an ETF, a Vanguard fund, or even blue chip stocks like BCE or whatever, I mean, you pay maybe even a full service commission, getting full service advice, and you pay $200 on a $5,000 ticket, for example, rather than $10 a discount brokerage. But if you can actually stay in that stock or dividend fund or ETF for 20 years, you're not going to be paying again until right at the end. That's actually a great deal compared to the 1% example that I gave. So personally, I think commissions are a darn good deal. And I'm maybe the panel can this was the question I heard. If commissions were banned, how do they, maybe this is a naive question, how does that affect discount brokerages? That's commissions. Does anybody know?
Well, we've done a lot of thinking on it. First of all, we have to agree what advice is being provided. If you are contributing $200 a month or less to a mutual fund, and you're worried about the advice that they get, what advice are they getting now? I'd like the industry to do a study to find what advice is being provided, and is it outside or inside the licensed amount? Are they providing tax advice? Are they really doing financial plans? I've done 900 complaints in the last 10 years, okay, at my team. We have never, ever, ever, and these are all mutual funds, ever seen a financial plan. Never. We have never seen one. People who have $25,000 in assets, you know what we would, I'm not an advisor, but if I were, I would say buy a good balanced fund and go to sleep. Or buy a good global balanced fund and go to sleep until you have enough assets to worry about it. Tax advice, I can tell you, people licensed by MFDA, very few of them know the Tax Act well enough to give the kind of advice I see given out, including that big issue with the TFSAs, where they all told, take the money out and then put it back in. They all got, hit with penalties. Stick to what you know. If you're going to give advice on mutual funds, stick to it. Do not claim your wealth managers. If they did that, I tell you, SEPA would back off a lot of things. The titles are so inflated, and it's related to fees, that it's just not right. I've got 400 business cards with different titles. Senior specialist, seniors consultant, investment advisor. There's no meaning. The profession is destroying itself. I'm an engineer. There's one title, engineer. That's it, PN. But if this industry wants to professionalize, it's going to have to make changes. And there's nothing wrong with that. The opportunities just for seniors are huge. I mean, I'm almost tempted to go back to work and become an advisor. Just in my condo, there's at least 100 people that are looking for guidance what to do with their RIF accounts. They don't know how to make sure it's going to be there for their expected life.
Well, I'm thinking about your example of $200 a month, and I'm thinking that 10% of $200 is $20, and 1% of the $200 is about $2 a month. And I multiply that by 12, because there's 12 months in a year. That means I have $24 in my revenue stream that I can begin thinking about how I can give any advice to anybody. And I can suggest to you, without exception, I have 266 homes that I work with, and they get a lot of advice with no contemplation of that. I don't sit down and figure out that a $200 a month pack is going to give me $24 a year. That's not how advice can be dispensed. Advice has to be dispensed on a need basis, which is exactly what you're speaking to. And that my contemplation would be that the people in your condo board might be well served to have you become an advisor. But I would ask, how would you plan to pay your bills if you had no revenue from your investments that you currently have? And could you make a business model out of serving the 100 clients in your condo? Could you survive on the fees? That nasty term we're talking about banning, could you negotiate the value around that? And again, I'm finding that we're deciding how a client is going to use our service, how a client is going to use our advice. And I can be very clear that when it comes to engineering, I refer to an engineer, and when it comes to accounting, I refer to an accountant, and when it comes to dentistry, I refer to a dentist. So my objective as an advisor is to see the necessity to bring in the professional, that I can see when a professional needs to be brought in. And that I think that it's a large leap of faith to think that I'm giving accounting, tax, or other advice other than this is something you should speak to your professional advisor in that field around, and here's an issue that you should think of. So there's something wrong with our model when we're trying to decide on behalf of consumers what choice around fees and how they're using the advice. The evidence is clear that the majority of Canadians are not in the $1 million plus range. The majority of Canadians have on average $228,000. And when you look at the average, if this hand's in a bucket of ice and this hand's in a bucket of boiling water, I'm the average. There's a large spectrum between that, and the majority of those people are below $228,000. And that's been my experience.
Ed?
I'd just like to make a comment on change, choice, and quality. There is change taking place in the industry. I think we have to be careful, and Ken, I'm going to make reference to a point you made about returns on mutual funds, true returns on mutual funds. I don't see that as a driving force for the change that has to take place in the industry, because if we look at returns currently, they're at historic lows, and they will go up again at some time. It ebbs and flows, the returns that are going to happen. So you don't want to make knee-jerk reaction and say, because returns are low, people are not getting the wealth building that they need. Therefore, we have to look at all sorts of radical changes. When I look at choice, if we follow regulatory trends abroad and start removing choice from the system, then it's going to impact the people that Greg was referencing at the beginning of the symposium, where he talked about, 37% have less than 10,000 and 57 less than 25,000. They aren't going to be able to get the advice that they need. If you look at the UK example, they're saying the cost for a fee for service is between £500 to £1,000. Well, you're not going to get any advice if you're in this income bracket or the savings bracket, and that's where the majority of people are starting out. And what we have to do is try to tie regulatory change to the broader government policy that's out there. And governments in Canada at all levels are facing record debt. The demographic changes in society are going to put an increased strain on resources. So more than ever, we need Canadians to be saving for their own financial future. And if you look at the Serrano study and other studies out there, even if you're saying at current interest rates or returns on investments, Canadians aren't making as big a wealth accumulation as they would in higher return years, they are still saving more. It's that discipline that's brought as well. So that feeds into broader government policy as well. So I just think that we have to be very careful. And the industry is talking about change. And there's no better group to institute change than the industry itself. They have the specialization and the understanding, and they should be working with regulators, trying to say, these are what we think the changes are. And the regulator should be saying, this makes sense, let's follow what you're doing. If you look at, and I don't want to get into this because I know it's a discussion for a later panel, but the raising the bar discussion that Advocis has started is all about that. How do we change from within to make sure that consumers are getting better quality service? That when they go to a financial advisor, they know what a financial advisor is. It's an undefined term at the moment. These are things that are happening, that are taking place, and I think those are the changes as opposed to the knee-jerk reaction that will lessen the access to advice, which will just exacerbate debt problems for governments and lower quality of life for people in retirement. And then, Jonathan, if I could just go to speak to your point, where you talk about at a certain point, moving from a commission-based to a negotiated sort of deal with your financial advisor. I think that's bang on. People should have the right and the choice to do that. You start off, if you have $25,000 and you're paying a 1% trailer, that's $250 a year. That's the greatest deal you're ever going to get. But the consumer is going to be educated as they go through this process as well. And at some point, they're going to say to their advisor, if their advisor doesn't say it to them first, we should be looking at a new model, because if an advisor was continuing to charge the 100 basis points on a multi-million-dollar account, that person at some point is going to be approached by another financial advisor and saying, you're being taken advantage of. So the advisors are, these are sharp businessmen. They understand how the market works, and they're prepared to make those changes as well with their clients as they grow and develop in their wealth accumulation.
I would say as long as the advisor sells himself as just that, I'm just an advisor. Once they start, what I've found and what consumers found in the focus groups is that the industry sells itself as providing financial planning services and all that encompasses. Unfortunately, consumers don't know that all the various elements there are to financial planning, the six various elements. What they're telling us in focus groups is that when they come in, they're being teased by the idea of getting a financial plan, the idea of getting tax advice, the idea of getting estate planning, to being sold securities. It's like a very fast train to that one element of the 6 elements of financial planning. That's an image issue on the part of the industry. The OSC itself came out in March and said that 1 in 5 Ontario investors trust the advice they're getting. That's a very, yes, there are other elements that come into play, probably a little bit of cynicism because of the downturn in the markets in the past few years. However, on its whole, that's a very damning statistic, and that betrays the idea that there is a definite image problem that needs to be worked on. And part of that is the confusion in regard to what are the obligations of an advisor, of a financial planner. Where's the distinction? Is there a distinction? I'll ask you the very basic question, since the panel's on this subject and we haven't actually addressed it. Do you feel that there does need to be a change necessary in regard to embedded commission?
In regard to embedded commission?
Right.
No, I don't. I think having the choice is important. And when we talk about the trailer of being 1%, only a portion of that is actually going to the advisor. And I just see the embedded commission as a real opportunity to capture a group within the market, a large group within the market that otherwise wouldn't get financial advice. And then if I look at the results, early results of what's happening in the UK, and the comments of the regulator there saying, boy, we've had a lot of unintended consequences here, we have problems. It's to the point where the politicians are saying we have to revisit now what we have done, because we're recognizing that a lot of people aren't getting advice, And that wasn't our intention. So banning commissions in the UK, they're saying, we've created a problem here for ourselves that we have to figure out how to get out of. They've then gone back to industry and said, okay, industry, what are the solutions to this? My mind is, before you made that change of banning commissions, you should have spoken to the industry and said, what do we do, what do we need to do in order to enhance saving and enhance the professionalism of financial advisors? If they had asked that question as opposed to go to the banning of commissions, I don't think they'd be having the problems in the UK that they're currently having in terms of the advisor gap that exists.
That's an interesting observation. I think the disasters in the UK, which I believe are worse than what we had here with ABCP and market timing, and, BRIAX, and we have plenty here too, believe me. In fact, one insurance company nearly threw in the towel with some of the gambles they were taking with their segregated funds. I think we should be careful. I think we should. So I would throw a challenge out to the industry. Instead of staying on the no button, every time a regulator proposes something, get off the no button and say, okay, let's look at it. If those firms in the UK had actually self-recognized a problem, they could have gotten ahead of the regulator, made proposals that would have been win-win, but they didn't, so the regulators took over. And that could happen here. So get ahead of it, get some research, look into what advice is being provided, what do these smaller people really need in advice. Don't overstate what you're going to do. Get some numbers, throw some statistics in, do some research, real research, and I think you'll find the regulators will pay attention. But just to stay on the no button, we're staying the way it is, it works, and give people choice. A lot of choices disappearing. Cell phone people they're being forced, the companies are being forced to change. The loyalty programs have had to change. Mortgages regulators are going to jump in if the industry doesn't move. So you see the challenges. Look how many people can't retire. What is wrong? Why is our debt so high? What did these 90,000 advisors do? So that's what has to be done. Change, do some research, give us data, and I'm sure regulators will listen.
Robert.
Thank you for that comment, Ken. And Jonathan, it's interesting that we are trying to solve that solution. I'm a member of Advocis, and Advocis is bringing forward the Raise the Bar, the recommendation to solve the issue around titles, the recommendation to provide the opportunity to define the space, provide the opportunity to assure Canadians that they're dealing with people who have a code of ethics, continuing education, higher education, and a level of performance that can be somewhat defined. So we are truly trying to solve those problems from within. But I'm paused for a minute because you talked about the importance of titles, Ken, and you talked about the fact that you're a professional engineer, you're a PEng. And it causes me to stop and wonder that, I know you're a member then of APEGA, is that true? So as a PEng, you're a member of APEGA?
Yeah.
Okay. How many non-engineers would sit on the board at APEGA? And it just pauses to think, because I know how many advisors sit on the regulatory boards, and there's very few. In fact, I think the number might be 0. So it's interesting that the people who are most affecting us as advisors, the people who are most directed in leading how we will survive in the environment we live in aren't advisors. Even yourself suggested maybe you should consider a career switch and become an advisor, and I've welcomed you in because that would give you a perspective that today you're looking over the fence of. And I think that the solution does have to come from within. And what we need is the openness of a regulator to listen and make room at a table, to hear what the advisor has to say, to hear what the client has to say. Because your complaints, and just to change this for a moment, you talked about 900 complaints in the period of time, that was the number, out of 10 million people getting advice. 900 complaints.
Yeah, but we're one group.
I appreciate that.
One group.
And
There's
every one of
hundreds
those
of groups forming. There's the Occupy group, which is challenging the whole Bay Street, Wall Street thing. These are winds of change that are so powerful that I think you should address them, and there's nothing
Absolute-
wrong with
Ken,
that.
absolutely. And you need to understand that I don't work on Bay Street and I don't work on Wall Street. I work on Main Street in small-town Alberta.
Good.
That I work over kitchen tables, not boardroom tables.
Now, you
And the necessity, every one of those 900 complaints, I'm not discounting, nor am I discounting the number, but I am discounting that we need advisors solving the problem. And so what I would ask is that you put your attentions to getting advisors on the committees that are being involved in this regulation. Speak for us.
I would be
because
glad to. I
that's
really
not
would.
what we're getting.
I am an advisor. I regard a consulting engineer as an
Financial
advisor.
advisors. Financial
But the
advisors.
principles are the same. Clients first.
Correct.
The principles are the same for you and me. We both have the
Absolutely.
same principles.
No
I
question.
would be glad, I'm on the advisory panel of the OSC. I would be glad to do that. As you know, we have invited IFIC and other people to address us. We're engaging probably more than the regulators are, all of the groups that represent the advisors. And I don't think, I wasn't there long enough. I don't know if Advocis has been invited, but I certainly would invite you to come and explain to us what can be done to make things better. Absolutely.
I think the unwritten, unstated word there was fiduciary, but Ed, you wanted to have a comment.
Yeah, I know there's some regulators in the audience, and it's a tough job being a regulator. You're never liked by everybody, and the best outcome for you is to be disliked equally by everybody. And it's also, regulating is a science, an art, and a craft, and it is a difficult one, and balancing the interest of the various stakeholders. But now that we've clearly seen regulators saying they want to focus more on the client-advisor relationship, I really do think that the regulators have to be speaking to the financial advisors directly. You have to speak to the consumers, there's no question about that, and all stakeholders, but I do find that there seems to be the lack of connectivity with the regulators, with the financial advisors, when they are making, recommending changes or contemplating changes that are going to directly impact that relationship. So it's an important element that has to be addressed.
Ed, I do want to point out that, Carrie List,
Yes.
he is on the advisory panel.
Yes.
And he's the one who signed off on our letters.
Yes.
Which was a 100% agreement. So anything we've submitted to the OSC, to the extent you agree that the CFPs are advisors, he is right in the middle of our panel. And he has recommended certain actions that you see publicly disclosed.
That's more of an interesting group as well. I mean, and I do see CFPs as financial advisors. I see it as a specialization, as a matter of fact. But that's not as much an advocacy group as it is a designation group. And while I have a great deal of respect for Carrie, some of the things I've read and heard, and then talking to financial advisors who are CFPs, they're saying they're not in agreement with what their CEO is saying. But I hear your point.
Who would be the right, like, who do you talk to?
The everyday advisor.
We can't talk to, like, is there a group?
There's
that
Advocis. I mean, we
There's
represent
Advocis.
11,000 financial advisors plus.
I'll be
in
glad
Canada.
to recommend you somehow connect in with our panel.
But, and it's important, particularly, I'll stop talking. It's particularly important that these are early days. We have to not start down a path and close our minds to other options that are out there. I think good regulation starts with identifying the problem, and before even selecting a path, looking at all the options that are available, and then determining which one is going to be the least disruptive to the market, and that's where you start. And you don't start a secondary path until you see what the results are from the first. So when I look at client relationship model and the transparency there, let's hold off and see what happens with that. Let industry continue to make changes as they see fit, because nobody to better regulate the fund industry than the people in the fund industry and the people providing the advice. Let's wait and see what the consequences are of changes that have started, regulatory initiatives that have started, before we start secondary ones.
Okay, I think we just passed 10 o'clock. I think we're at the stage we're going to read some questions, correct? Here's something on the high fees. How can fees be lowered for consumers so Canadians don't pay the highest fees in the world? If you don't end the perverse form of competition that exists today, which is competition to pay higher trailers to advisors? Anybody want to take that one on? That's pretty well to your point right at the outset there, Ken.
Well, how they can be lowered is, I think, one of the rules as a consulting engineer I have is that we would, when we're looking for suppliers, we go with the lowest responsible responsive bidder. The lowest responsible responsive bidder. So he has to be compliant, he has to meet the specs, but then we go with the low price. It's got to be the lowest.
Which in this market is ETFs for the most part. I think that's one reason why ETFs have
The
become so
problem
popular.
The problem for mutual funds is that the fee barrier is hard to overcome when the rates are low, and it gets noticed more by investors when the net return is low. When things were running at 13% and the fee was 2.5%, still made a hell of a lot more than a GIC. Now, after taxes, and now they've added the HST, unfortunately, to mutual funds as well, it's really made that industry tough. So the real proposition is going to come not from a transaction-based, my opinion, a transaction-based system where you get paid based on selling, where you should be compensated for the value add you make as a professional advisor. Whether that automatically leads to embedded commissions going away, I don't know. But I do know that there's a real opportunity for advisors, but the mutual fund route with the way things are developing is going to be very difficult. It's going to be very difficult. And remember, these advisors, portfolio managers, are pulling $1 million, and 85 out of 100 of them can't meet a passive benchmark, according to Spiva.
Okay, we want to get through a few of these questions. So this one's addressed to Robert. The type of comprehensive fee discussion with your client, do you believe other advisors provide that comprehensive review? Is it a lot of the problems due to reluctance by advisors to discuss fees frankly with their clients?
Well, obviously, I can't speak on behalf of all advisors, but it would be my submission that a lot of advisors have disclosed at one time or another in the process, without exception, how the fees. It's interesting, I was reading some research that said the advisors have in their process the disclosure of fees, and later when the clients are asked, they don't remember the advisor talking about that disclosure. So I think that you have a gap, and the necessity is to continue to review that fee structure so that your clients continue to see it and hear about it. And what we're talking about is the necessity of the best practice model. The best practice model brings forward in the raising the bar solution. So it again speaks to the necessity of the raising the bar proposal, which has everybody participating in a best practice process.
This question appears related, so I'm not sure if it'd be for you or perhaps Ed. There is no requirement to provide any ongoing advice while receiving a trailing commission. What advice do consumers get if they have $10,000 in mutual funds with an advisor/dealer?
I can make this easy for you. On the whole, they don't.
Well, Jonathan, hang on a second. If my phone rings and my client calls me, I don't look up their assets to determine if I'm going to give them advice.
No, but
so I think that there has to be some interaction, and I'm actually a little bit surprised that the sense of entitlement Ken brought forward in talking about, how can there be so little advice, and whose problem is this? Well, I can tell you my phone works both ways. And when they call in, not to say that's the only time, but when they call in, they can certainly get advice.
Well, I would suggest, and I don't have any numbers to back me up, but you must be in the minority. No? Okay. Okay, I apologize.
Just to maybe move this forward, isn't this a question of what the consumer is educated to expect? Shouldn't we be thinking about getting our consumers to ask and expect? We're all trained in this room to ASK and you'll GET. GET. Ask and you'll get. ASK well, GET. And it seems to me that we need to educate consumers to close the gap for themselves. Respectfully.
Well, and that's the role of the media in some ways too, because if we educate them through articles, again, I urge you to read Preet Banerjee's article in Money Sense called "The Perfect Financial Planner," because I think we're trying to. Somebody had said earlier that the media were hostile to the financial advice industry. I would have said I don't think so. Personally, even though I'm a do-it-yourselfer and with discount brokers, I still use a financial advisor. Always have used a financial advisor. Was quite happy when I had a commission-based one, less happy when I had an asset-based one, and currently use a fee-for-service. Again, there's a big distinction between fee-for-service and asset-based.
Here's to choice.
Exactly, I agree, it's choice. And as I said before, I think even commissions can be a great deal. So here's one for Ken. If advisors are paid for fee-for-service only, what do you think clients with meager assets, about $25,000, should pay for a comprehensive financial plan?
First of all, let me correct this misperception that CFA believe that there shouldn't be choice. We have never said that. We don't say that. What we say is we would like people who give advice to define what advice they're going to give, what are the constraints on that advice. Don't over-advertise. Do what you say you're going to do and do it well. That's what we say. There should be clear best interests. Now, how that's defined, we need to work together on defining that. It can't be perfect, we realize, because the nature of any business, even this car mechanic sometimes may overcharge. So I think the solution for the small guy might be a different level of advisor. For instance, there's engineers, there's technologists, and there's technicians. They have different skill levels and they charge different rates. My rate is a lot higher than a technologist. So the small guys can't afford and don't deserve to get top quality advice. They absolutely don't, because they don't have enough money to do it and they don't need it. When you look at some of the advice, the tax, I've seen people that pay no income tax, at least 200 that I know of in the 900 cases, putting money into RSPs. They're never going to get a benefit out of this. So if you're an MFDA and you're giving advice on mutual funds, terrific. You want to do that, don't call yourself an advisor or give yourself a different title. You know, salesperson is what they used to be called. There's nothing wrong with that. It's a proud profession. So professionalize the industry. Don't let people who are not professionals get the same fee as professionals. I just think it's unfair to advisors.
I'd like to just make a quick comment on that. When we look at preparing people for their financial well-being, it's really their financial health. And if I then use the analogy of a doctor, when I go to a doctor, I'm looking for my personal health. I don't want to be told that because of who I am, I cannot see a doctor, this professional. I should be seeing somebody who's a lesser professional. I think the same applies to financial advice. If you need financial advice, just as you need care from a doctor, you shouldn't have to take a lower standard because of the money that you have to invest. Your financial health is as important as your physical health.
It's a philosophy that you have. I happen to have a different one. I think if you have $200 a month to invest, you need a different kind of advice. You don't need as much wealth management. You don't need as much taxation. You know, if you're making $30,000, taxation raises. It's not a big issue for you. So why should you expect things that you don't even need?
But if you can
and
have
why should you pay the same no matter who you are?
You're not paying the same, though.
Well, you're paying 1%.
You're paying 1%, but 1% of 25,000 is far different from 1% of 1 million. So I don't understand why we would make changes that would remove the same high quality of care based on income or based on assets available.
That's one of the things we need to debate.
Yeah.
We should debate that. I'm not hardline on it. I just don't see why. I think the real need for Canada is the seniors and retirees and the RIF accounts. There's where I'm really worried they're going to outlive their money.
Okay, so we made that point before, and I think that debate we can have at the coffee break. This is just a one that came in, probably the last question, and it might sum it up nicely. The greatest impetus for change is a free competitive market. Do you believe clients have a right to choose from a diverse market? Advisors have a right to offer their services to a free market, and product manufacturers have a right to compete on a free market.
Absolutely. One of the questions that was in the brochure for us to address is, will there be an advice gap? What's going to be the reaction if this kind of a ban comes in? When I sat back and thought about that, I was thinking, well, hopefully what will happen is that the market will correct itself and that advisors will start coming out with a pre-packaged setup where for X number of dollars you will get your yearly financial planning meeting, and to help those investors with the smaller portfolios, because under the current model it's great to be able to have access to the advice, but inherent in that is that conflict between advisors, the consumer, and the fund developer. Consumers don't know that that relationship exists. I know the industry is attempting gravely to get that information out there. Consumers are coming back, as you folks have said, and said, well, we conveniently forgot that portion of the meeting. However, I think as long as we're under this particular model, more and more work needs to be done to make consumers aware, and that information has to come from the industry.
We have 1 minute left. I think, Ed, you should have the last word.
Thank you. Doesn't happen too much, especially at home. You know, I think, and I've said this before to people on this stage, that the best thing we can do is be talking about our differences. And I think when we talk about our differences, we start recognizing that we have more common ground than we realize. And when you recognize that, it makes it easier to build a momentum to institute change, because I think everybody on this stage agrees change is needed, change is coming. The consumer has to be the most important person in this equation, and I think we're on the right track by having these sorts of discussions, and they have to continue, and they have to involve the regulators, and the regulators have to invite everybody who's going to be affected.